Hello and welcome back. Talking about financial statements in this series, and today we're going to talk about fixed assets and long-term debt. We're going to put them both into one video. Fixed assets analysis involves calculating the earning potential, use, and expected life of the assets. So fixed assets, equipment, tools, vehicles, desks, furniture, these are all fixed assets. They're used for the company to be able to produce income. So what is that earning potential use of that asset? What's the useful life? How long is it expected to live for? So want to determine if the fixed assets are sufficiently maintained to ensure current and future earnings power and relatively the profitability contributed by fixed assets and fixed assets acquisition. So we're saying, how much do these assets contribute to the profits of the company? And if I was to purchase more assets of these type, what would that contribute to the company, right? Now, when it comes to looking at fixed assets, the bottom line is that you have to actually dig into the fixed assets and see what they are and see what they produce. There's not a formula for that per se. You have to actually dig in. Now, these are questions that can be answered if you're looking for a public company on the audit, or if you're a private company, you got to ask the question. Okay, very important. Now, we can also talk about long-term debt, which is also in the company's balance sheet. So the fixed assets are under assets, long-term liabilities under the liabilities or debt section. And again, this is money that will be paid out that is over a period of time. So long-term is things that are not paid off in the next 12 months. You might have a current portion of that, but long-term is definitely things that are paid off past 12 months, whereas current liabilities are things that are paid off, liabilities, debts paid off in the next 12 months. A great sign of prosperity on a balance sheet is where the long-term debt has been decreasing year over year. So when you're looking at historical information on financials, you want to look at the liabilities going down, while hopefully the fixed assets or assets at least going up or staying the same with depreciation, bringing them down. You want a company that's producing revenues and paying off debt. Okay? Companies with too much debt, obviously, will find themselves overwhelmed because interest payments, right? A risk of having too little working capital, and ultimately maybe bankruptcy. So very important to look at that long-term debt year over year and make sure it's being paid down. If you have any questions, we'd love to hear from you. Please do post in the comments below, and we'll look forward to seeing you in the next video.